Which are the sectors of the economy that will rebound the fastest? Can stock market predictions and a little market history help you take advantage of the lower prices for huge returns in the rest of the year? Hey Bowtie Nation, Joseph Hogue here with Let's Talk Money, and welcome to another episode of Ask the Bowtie Nation. I'm loving the series here. We're posting one of your questions in our Facebook group, Let's Talk Money Together, and getting some great answers from everyone in the nation. I'll leave a link to the Facebook group in the description below, or just go to Facebook and search for Let's Talk Money Together. Today's question comes from Dwayne, and it could be one of the most important questions you ask yourself right now as we try to find our way out of this 2020 stock market crash. Okay, Dwayne asks, which markets are going to recover first, and would it be possible to use a sector investing strategy for returns in those early winners and then shift to the ones that are rebounding later? I love this idea of sector investing, okay? Looking for the stock sectors that are going to recover the fastest. They're going to benefit from that $2 trillion plus in stimulus money. The idea here is that you can take a quick position in some of these stocks, and then you can take your profits to roll into some of those other sectors that are going to be benefiting later on in the recovery. And what's great about this strategy also is that it's so much easier and it takes less time than trying to pick those individual stocks right off the bat. Okay, for example, you can try to pick the next hot stock out of the 3,500 plus tradable in the U.S. exchanges. But where do you start? Okay, it's a crapshoot digging into the financial statements of each company. But if you can find the sectors of the economy, okay, so those big groups of companies like utilities, consumer staples, technology, or financials, find those sectors that are going to benefit first, then that narrows down your list of stocks to buy down to just a few hundred. From there, you can focus on that group to pick the best of breed in each sector. So then you go into that fundamental analysis, you go into the financial reports and the analyst reports, and you look at each company within that sector. But so even better though here is that this type of analysis is so much more certain. Okay, honestly, you got to be like the love child of Stephen Hawking and Warren Buffett to bat more than 500 on individual stock picks. But it just takes some simple analysis to understand which sectors are going to benefit from those big universal forces in the economy and the stock market. Understanding those big economic forces are going to be driving all stocks in that sector, and you're going to be getting strong returns no matter what stock you buy in that group. Okay, so first we're going to look at some of the responses we got from the Facebook group, which sectors you and the Bowtie Nation think is going to rebound first. Then I'm going to share my own list, look at some great research from Wall Street analysts, and put together an investing strategy just to take advantage of all of this. I'll leave a clickable index in the video description below if you want to jump around, but watch the entire video because we're going to be taking a great look at the bigger picture here and the stock market. We've got more than 6,000 in the community there on Facebook and some great responses. Matt thinks consumer staples are going to rebound first, and financials and real estate being really the last sectors to recover. Sibylina and Michael both put the tech as one of the first to recover. One of our founding members of the Bowtie Nation, GE, gave us his whole list here with the staples, communication services, and tech topping the list, while materials and real estate are the last to recover. Really some great responses, so join the group and take a look there, but I created a kind of a heat map showing the timeline for sector recoveries here. Most were pretty clear that tech stocks would be the quickest to recover, followed by staples, communication services, and stocks in the utility sector. The middle group of sectors didn't get a lot of votes, but people were more confident on the laggards here, with financials getting the most votes for the last to recover. Next were also real estate stocks and consumer discretionary for that slowest to rebound. Now I want to show you some investing resources to help you with that idea of creating your own stock market predictions and really look at these sectors. Then I'm going to share my reasoning for which sectors I think are going to be primed to move higher and which are going to follow. So here I'm going to be using the FactSet Earnings Insight report for a lot of these charts. And Nation, this is an excellent bi-weekly survey that I've used as an analyst. It includes analyst estimates and stock market forecasts. It's totally free. Just search on Google for FactSet Earnings Insight. And first, I think it's important anytime you're making that kind of stock market forecast is just to start with the current valuation. So a lot of investors are looking for those cheap stocks, but if we look at the forward price to earnings ratio, that's the current price of stocks divided by the earnings expected over the next year, stocks aren't necessarily cheap at this point. Now I'm going to leave the energy sector alone here because earnings are expected to just crater over the next year to almost zero, so the chart's really thrown off here. But look at some of these other sectors. The consumer discretionary sector is trading at a price of 23 times earnings. That's the dark blue line here, and you can compare that against the 10-year average PE ratio in green. So over the last 10 years, the consumer discretionary sector, the stocks in that consumer discretionary sector have traded for around 17 and a half times forward earnings. And right now, stocks are priced at 23 times that. As some of the sectors are a little closer to their averages, so consumer staples is trading at 18.7 times earnings against a long-term average of 17.4 times. Most of the sectors are trading right around 15% higher, though, than those long-term averages, except for healthcare and financials. These are the only two trading at or below their long-term average PE ratios. So here, remember, it's not just when you think about these sectors, which ones are going to rebound first, but where they're starting at as far as prices. Even if technology should recover fairly quickly from the recession, stocks in the sector as a whole are trading at almost 20 times their earnings. That's 30% higher than that long-term average. So rebound, yes, but they might not have that much farther to rebound. Next, we can look at analyst estimates for earnings, and obviously the picture isn't pretty here, but I think it's a really great perspective on which sectors are being hit the hardest and which are relatively safer. So we see that analysts expect technology, healthcare, utilities, staples, communication services, and real estate to still post positive earnings for the year. Now, against that, we see the biggest weakness here in stocks of consumer discretionary, industrials, financials, and energy stocks. And now if we compare those expectations with another chart for earnings expectations for next year, so 2021, we see some really interesting differences. You actually almost see a mirror image here with stocks in the energy sector, industrials, and discretionary goods expected to post the best profits next year versus those stocks that did relatively well, that did the best this year, maybe lagging a little bit. So obviously, Wall Street analysts are forecasting strong economic growth next year and for some of those hardest hit sectors to bounce back. We'll look at one more graph here before the actual returns that analysts expect from each sector in the economy, and I think this one is even more important in that it shows you where profitability is going for these sectors. So you see here the profit margin for each sector. Okay, so that's the earnings, the profit for each company divided by its sales. So how much of sales it keeps as earnings and those profits for the company. And what we're seeing here is the first quarter 2020 profitability in dark blue, so this most current quarter, with the comparison quarter in 2019 in gray. Okay, so something just to compare it against last year. And most interesting here is that some of these really haven't seen their profitability get hit too hard, according to analyst expectations anyway. So maybe an idea that these sectors can bounce back more quickly than forecasts when that revenue returns. Okay, so when their sales actually return from zero from these lockdown conditions, then since they still have those high profitability numbers, then their earnings can rebound pretty quickly. So the strongest sectors here in terms of that profitability, in terms of those earnings rebound, are going to be real estate, IT or technology, utilities, and then stocks in the communication services sector. Now let's look at the actual return predictions for each of these sectors according to stock market analysts, and then I'll reveal which sectors I think can recover and which offer the biggest opportunities for investors. So the fact that communication services is really doing well here with a 23% expected return shouldn't surprise anyone. Many of these companies in internet and telecom are actually benefiting from everyone being at home and online. Now, what's really interesting here, though, is the fact that analysts expect stocks of financial companies and consumer discretionary to do so well over the next year. We've got returns here of 23% and 19% on each of these two sectors. So I think part of this is just on valuation. Okay, so the fact that the stocks of financial companies are trading at such a low PE basis, right? Such a low price to earnings basis. But you've got to wonder whether these two sectors can really outperform the rest here. Yeah, coming from that lower point, so you have more room to rebound, more room to recover, but the earnings picture is still not good. So I'm not sure I'd be betting on these two, and you'll see my predictions next to why that is. Now, we also see that analysts have forecasts for the broader market, the S&P 500, to return 17.8% over the next year. That turns out to be about 3,200 for the S&P 500. Still a little bit below the high in February, but a nice return. It's also interesting to see that even though energy has been beaten down so far, the analysts are expecting it to be the second worst sector on returns. Honestly, I don't think this really makes a lot of sense here, because if analysts are expecting that strong economic recovery and a rebound in these other sectors, then that should really drive demand for some of these energy products for oil prices, and it should bring the energy sector snapping back fast. So that's Wall Street's stock market forecast. And now I want to go through each of these sectors, show you which I think are going to rebound the fastest and why. First here is consumer staples, healthcare, and technology. And these are all down less than 5% year to date versus that 11% market drop. So these sectors are probably already in their rebound. I think stocks of utility companies is probably one of the hidden opportunities in this market. The sector is down 6% year to date on fears of that lower business demand in electricity and other utility services, which is certainly founded. But these companies are regulated by their local governments and they're still going to make a profit. Okay, they're regulated to make money. These are strong safety companies with solid yields. Next here, communication services is also very interesting because while it's down almost 10% on year to date, a lot of these companies are positioned to benefit from those shelter-in-place rules like Netflix, Electronic Arts, and Alphabet, the parent company of Google. Stocks in the industrials and materials sector should be fairly quick to rebound also. These are cyclical sectors, which means they follow the economy pretty closely. So as all that stimulus money starts working its way through the economy, hitting business, and as business starts just getting back to work in the first place, these sectors should start looking a lot better. I actually think the energy sector is one of the hidden opportunities right now. Analysts are expecting it to post the second lowest return over the next 12 months, and the sector has lost almost half its value so far this year. But if you're following Warren Buffett, right, and you're looking to buy when there's blood in the streets, this is definitely the sector to start looking at. It's also where you'll need to do the most research, though, because a lot of these companies aren't going to make it. Okay, so pay attention to the balance sheet, how much cash a company has on hand, and that 10K annual report for how much debt it needs to repay or refinance over the next year. That's this debt maturities. Those two alone are going to be your best insights into that company's survivability. Next are stocks of financial companies. So banks and insurers mostly might see a lot of loan volume with these interest rates at rock bottom, but they're just not making any money off of it. You see, the problem with the financial companies right now is with long-term rates as low as short-term rates, there's no spread there. They can't make a profit between what they pay on deposits and what they lend out. So banks can't make any money and insurers can't find a safe place to invest all that cash. Now, the good thing about this recession, the one good thing is that financial companies were in a very good place going into it, as far as capitalization and loan losses. So you still got strong companies. They're just not making any money. Now, real estate is probably looking at least a year of difficulty in the rebound just because it's such a lagging sector. So leases for commercial space are long-term, which means that rent rates don't come down as fast, but they also stay weak for longer as those lease contracts gradually expire and tenants renegotiate. Residential real estate is going to get hit on that rent forbearance and the prohibitions on evictions, but it also should rebound fairly quickly. Now, I actually did an Outlook video on all 10 property types last month that I'm going to link in the video description below. I would look at those data centers and those digitally focused REITs as well as maybe storage and healthcare, but avoid REITs with any office space or retail. Next here, consumer discretionary is a real wild card because there are some here like Amazon and eBay that have done very well this year. Plus, there's also going to be some like McDonald's that should rebound fairly quickly as people get back to work and get outside. But a lot of these retailers, the department stores and the stores that are typically in malls, those companies are in big trouble. Nation, these companies in that traditional retail space, especially the apparel retailers, they had razor-thin profit margins and already high debt as it was. And now with high unemployment, retail sales just aren't going to be snapping back. Okay, think about it. If strong brands like Toys R Us and Macy's couldn't cut it when the economy was growing, there's just no room here for even a recession, let alone to have stores closed for several months. So Nation, what I want you to get from this, if you're looking to try to make those stock market predictions from this, remember that the stock market actually isn't that far off from its highs in the first place. Okay, Wall Street analysts are expecting earnings to be down about 10% from where they were last year, so 10% lower in 2020. And yet the stock market, the place where it's at right now, the level about 2,800 is only right about 10 or 15% down from those February highs that we saw already. So if you're looking for stocks to really rebound, there might not be much of a rebound left. If the S&P 500 is trading at 17.3 times expected earnings, which are already above that 10-year average of 15 times forward earnings, so we're not exactly in value territory like we were in mid-March. So I want you to look through these sectors and you can kind of make your predictions for which are going to rebound fastest and where you want to put your money. But just don't feel like you need to rush into stocks on that fear of missing out, and just save some of your money back for another stock market crash if we do get one. Click on the video to the right for the 5 best stocks to buy according to analysts, as well as the 5 to avoid. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.